Hey guys, in this video, I'm gonna cover price cycle. One of the most interesting and significant ways that I've learned using SMC on how to enter the market, right? So at this point, we've covered market structure, break of structure. We understand the phases of the market. We've understood when to enter the market, what are the best times in the market, whether in a pullback or in a swing, to anticipate all those good things. And now we're gonna polish more on how we can enter the market, the patterns we need to look out for entering the market, right? So price cycle covers that a lot. By the end of this session, you should be able to understand it, hopefully, and then you should be able to apply it. Because if you do, you see that your entries, your entries and your winning rate is going to increase for those people that are actually applying the knowledge at this point, right? So price cycle has got 4 phases that you need to look out for, right? 4 phases that you need to look out for before you engage with the market. First of all, the first thing that we tend to see is that the market should be consolidating, right? The market should be consolidating, right? Ranging between two levels of supply and demand, right? And then from there, we see price pushing to the downside, right? Expanding. This is what we call expansion, right? We see price expanding where price impulsively breaks out of the consolidation, right? So as price is expanding, what happens is that it tends to leave an imbalance, an inefficiency, right? So as it stated here, this is when price impulsively breaks away from the consolidation phase. Note, when price expands, it leaves behind efficiency. And this efficiency is symbolized by IMB, which stands for imbalance, right? So when price leaves an imbalance, which is something like a gap, like most people call it a fair value gap, right? It's like a fair value gap, but basically it's a gap that causes the difference between the buyers and sellers. So during market structure, I covered how ranges are made, right? How ranges are made, what makes ranges. So let me just go through that, right? So that you guys can understand where the imbalance is coming from, right? So we know that when price is ranging between two sideways, there are equal number of buyers and sellers in the market, right? The equal number of buyers and sellers in the market, right? But at the end of this range, we see an expansion where price breaks out of the range. Once price breaks out of the range, whether to the upside or to the downside, we see an imbalance of one of the parties, meaning that if we probably have 50 sellers here, and then we've got 50 sellers here, this will cause a range, right? But once we get 10 more sellers, right? We get 10 more sellers more than the buyers. What happens is that we cause an imbalance of 10 more sellers. This imbalance right here, this impulsive move, that's quite volatile, right? This imbalance here that's quite volatile is what causes inefficiency, right? Hence leaving the gap, right? Hence leaving the gap that needs to be filled up later in the market. So in this case, we have price, right? We have price expanding after the consolidation and then retracing into the consolidation phase. So this is the third part of the price cycle. So the retracement phase is usually corrective. It's usually correcting towards their phase, right? So what I mean is that when price impulsively shoots a downside, we tend to see this correction. And the reason why correction during retracement, right? Price tends to induce liquidity, meaning that it tends to fake buys, right? Most people start to buy because they're seeing some sort of trend, right? People that trade trend lines, yeah. They're seeing some sort of trend and then they try to engage with the market, right? Hence inducing buyers to jump into the market, right? And once price reaches into a significant zone within this consolidation phase, right? We'll see a reversal, right? A continuation into the trend where price expanded from, right? So if price expanded to the downside, we see a reversal to the downside, right? So during this phase, we see price accumulating liquidity, right? Accumulating liquidity, inducing liquidity. And during the reversal, we see price grabbing all the liquidity to the downside, hence pushing down, right? So these are the 4 phases that you need to look out for: consolidation, expansion, retracement, and reversal, right? So just make sure that you look out for the liquidity that's been induced during the retracement, and then you look out for the imbalance that is formed during expansion. And then the last thing that you need to look out for is the supply or the demand zone that is formed in the consolidation phase right before the breakout, right? So before price breaks out of the consolidation of the range, it tends to leave a zone or an order block that you need to look out for. That price is going to come and respect, where you're going to jump on as your entry, right? So it's quite easy. So just make sure that the consolidation phase, right? Just make sure that the consolidation phase is in alignment with market structure. Make sure that this is, let's say, from down here, we had an impulsive move, price corrects, does push the downside. So this right here, make sure it's in this alignment. It's in alignment to market structure for this strategy to work most of the time, right? So now I'm going to show you guys a couple of examples that you can apply, right? That you can apply both in an uptrend and a downtrend. Okay, so this is the first example, right? Obviously, as you can see, price was pushing to the downside, right? And then it came back into this phase, failed to break past this level here, indicating that we're still in a downtrend, right? And then we had consolidation. Price breaks out of this impulsively, leaving this imbalance here. That's grabbed, right? Price grabs this liquidity, fill up the imbalance, right? Correcting to the upside, and then respects this block and shoots down, right? So as you can see, all the phases are being applied in the right way. First of all, we are in a downtrend. Second of all, price leaves an imbalance during the expansion phase. And then third of all, we see price correcting towards the supply zone, right? Price correcting this towards the supply zone, respects the supply zone and pushes to the downside. And as you can see, it was inducing buyers. It was inducing buyers to jump into the market correctively. Hence, I highlighted this liquidity line here, right? Buyers being induced, and then we see price grabbing the liquidity down there, right? And then another example in a bullish market. So here we see price first of all push to the downside, right? We're in a downtrend, push to the downside in a downtrend. Price consolidates. We see price break past the highs, right? Hence change of structure, right? We see a change of structure. Price is now in a bullish trend, right? We see price massively push to the upside, hence causing all this imbalance right here, right? We've got this massive imbalance that needs to be filled in. What happens is that price forms a double tap here, inducing people to buy the market, which it does push to the upside, but eventually comes back, takes out the liquidity, right? Takes out the liquidity and then push to the upside. So as you can see, all the phases, just like the previous example, have been applied in the right way, right? So another example is going to be this right here, right? So just like the first example, we are in an uptrend where we see price push to the upside, and then price consolidates. Price leaves a zone, right, at this point. So this is the block that price leaves on, right? And then price impulsively pushes to the outside, breaks, hence causing this imbalance right here, right? Imbalance fair value gap. That price comes to fill up, respects the supply zone, and then shoots to the upside. As simple as that, guys. As simple as that. This is one of the most consistent strategies. So if you can just go on the chart and try to look for this pattern on the lower time frame, on the higher time frame, right? Provided you're looking at it and trading it in confluence with market structure, you should be able to retain a good winning rate out of this strategy, right? So let me give you two more examples. So here's another example, right? We see price ranging, consolidating, coming from an uptrend, right? We see price coming from an uptrend, consolidating. It pushes down, right? Leaves this imbalance right here. Price starts to induce buyers, right? Buyers, people trade trend lines, trade this to jump into the trend. Price pushes to the upside, the liquidity is grabbed, right? First of all, we're in a downtrend. Price leaves significant zones right here that needs to be respected. It impulsively breaks downside. It accumulates orders right here, induces liquidity orders right here, and then grabs them later on, right? So that's it. And then there we have the last example is we have a consolidation, right? Price consolidating and then breaking to the upside, leaving this imbalance right here, right? Leaving this imbalance right here, and then from there inducing, right? Inducing this liquidity here that's eventually grabbed, price respect the zone and push to the upside. Yeah, so this is a price cycle, guys. It's one of the most efficient ways you can enter the market, and I've used this 1,000 times, and it works out accordingly. most of the cases, right? So make sure you practice it, make sure you go through it, make sure you understand market structure, breakup structure, imbalances, how to identify order blocks and supply zones, right? And now you should be able to profit from this. All right, have a good one, guys. Bye.